So investors are certainly very excited about that, but they're also starting to get a little bit cautious, and they're trying to understand how to position for the second half of the year.
Hi everyone, and welcome to the Curious Investor, Saxo's video series where we dive into the topics which are driving the investment markets. I'm Fiona Koo, and today I'm with Charu, our market strategist, where we'll be discussing about how you can protect and enhance the returns for your portfolio. So stay tuned to the end of this video because we're going to dive into these different portfolio strategies for this momentum-driven market. And yeah, hi, Charu, welcome to the show.
Hi, Fiona. Yes, absolutely. Again, such an important topic because we've seen such a strong rally in the first half of the year, right? Nasdaq's up 40%. So investors are certainly very excited about that, but they're also starting to get a little bit cautious, and they're trying to understand how to position for the second half of the year. So again, I think this episode is going to be very helpful to all our listeners.
Yes, exactly. And I mean, with all that's been playing out, in the macro environment right now, with Fitch ratings recently downgrading the U.S. long-term rating to AA plus from AAA. So I think that has caused, some concerns within the investment space, for traders and investors alike. Yeah. So where do you see this, heading?
Yeah, so absolutely. I mean, some of the leading voices have actually said that this downgrade does not make sense. But I would certainly say that the debt trajectory of the US is concerning. The debt to GDP levels are expected to cross over 100% in the next few years. And for a AAA rated country, that is not something you would expect. So maybe as it is, it might not have such a big effect. There may be a very small percentage of funds that have a AAA mandate, but shifting away from US treasuries might still be tough for them. So that itself it probably is not such a big concern. But if we see a cascading of this, into the corporate sector as well, we have a huge amount of corporate debt maturing up until the end of 2024. And of course, if interest rates are staying where they are, that refinancing that the corporates will have to go through at potentially higher rates could bring in a significant amount of tightening in financial conditions. And even if you think that the investment grade corporates would stay safe and they have a strong balance sheet, I think there are concerns about the high yield sector, and the high yield sector itself employs about 15 to 20% of the US labor force. So again, I mean, if there are concerns, if there are delinquencies, if there are bankruptcies, we could see an impact into the labor market as well because of that, which could also mean some constraints on consumer spending. And I think obviously business spending will likely be pulled back as well. So I think, I mean, there are reasons to be cautious about the amount of tightening that we've seen. So far, investors are really enjoying the disinflation story. They are enjoying that the Fed is reaching a pause, but we really need to understand whether from here that tightening would mean that the Fed has really engineered a soft landing, or we do still get a recession in the second half of the year or early 2024.
Yeah, I think that's very interesting. You mentioned these are definitely the concerns that investors have on their heads right now. And I think for this year, we've seen the rally, it's been very much concentrated in various sectors, especially for tech.
Yeah.
So what do you see, in terms of the potential for other sectors?
Yeah, absolutely. I mean, the rally that we've seen has been driven by multiple expansion. It has been driven particularly by the multiple expansion of a few stocks, be it because of the AI story that's been leading the market, so a lot of enthusiasm for that. But just these higher PE multiples does mean that those companies have to deliver a very strong earnings momentum to be able to justify those multiples, which is obviously looking a little bit hard at the moment, just coming out of the earnings season. Most of the tech companies have either met or exceeded consensus expectations, but we've not seen blowout results to be able to really justify their high valuations. So from here, I would say that, it depends on, again, whether we get a soft landing or a recession. But if this soft landing theme continues to pick up, if economic data continues to surprise us on the upside, then of course there is a potential for this rally to broaden out. A lot of investors who've been left out are trying to get a participation in this rally. So they're looking for sectors that are a little bit undervalued, or they do not have such demanding valuations as the tech sector. So they're going to come in as well. And just the whole notion about the soft landing continues to suggest that investors will continue to broaden their exposures to the equities as well. So in that case, I think energy sector looks quite attractive because that is the cheapest sector in the S&P 500 right now. There are other sectors like, say, renewables, electric vehicles. We talked about electric vehicles in one of our other episodes as well. So, of course, they could gain a lot of traction if economic momentum is sustained. We are also seeing a lot of focus shifting towards emerging market equities. Central banks of Chile and Brazil have already started to cut rates. So they are really, in a different point in this monetary policy cycle, and that's really supportive of their equities as well. So there are a lot of these strategies, these sectors, and just the diversification regionally as well that could help investors if they want to kind of get a better participation in the equity market rallies. But if there are concerns of recession picking up, then it certainly makes more sense to have a defensive positioning. And that would, I think, bring into focus sectors like consumer staples or healthcare or utilities.
Yes, I think the point that you mentioned about either there's going to be either a soft landing or recessionary concerns coming up, that is definitely something that investors and traders are thinking about right now. And aside from that, China as well, the growth has been quite slow to pick up with the numbers that they've been publishing. Altogether, I think the market's sentiment is pretty downcast in this environment. So in this kind of environment, I think for investors or traders, they can definitely consider option strategies.
Yeah, absolutely.
Yes. So what they do is, because option strategies, they allow investors to risk manage their portfolios and either enhance or to protect their returns. Yes. So one of the strategies would be the protective put strategies. Yeah. So this would be quite interesting.
Yeah, absolutely. So protective put means you have a long position on a stock, say, and you can just buy a put option on that stock as well with a higher strike price if you are scared that the market will fall or that stock position will actually go down. So if you have a put option, you have the option to sell it at a higher strike price if the market actually goes down. And if your stock continues to rise, then you can leave that option unexercised and you can just continue to enjoy the higher returns in that stock. So certainly, I think that's a very common strategy that a lot of people use if they are scared about a downturn, which is expected to come in the markets. But there's also a lot of strategies that can just help you to increase the returns of your portfolio without really taking much of an additional risk as well, right?
Yes, exactly. That's a great point. So protective put strategies, that is very good for investors who wants to hedge their current positions. But another alternative would be the more yield enhancement strategies or income generating strategies. So for example, we have the selling of covered calls. So for investors who are already holding, existing holdings in a certain instrument, and they have a long-term view on it, but it's taking a while to maybe go up. So they want to collect premiums on the way, so they can consider selling covered calls. Yeah. So what they do is that most people, they will set a strike price, which is a bit higher than the current market value. So it's an out of the money call option, and they actually hold the existing underlying instruments as well. So they don't mind to actually sell this instrument at that higher strike price, even if it goes up. But at the same time, if it doesn't go up, they still earn the premium.
Yeah, the idea is to get some premiums, and that helps to increase the return of your portfolio.
Exactly. So another kind of strategy, which is also yield enhancing, would be the cash secured puts. But the difference is that this would be to sell puts instead of selling calls. And For this, it would be suitable for clients or investors who have cash on hand, and they are setting it at a strike price which is lower than the current market value, and they don't mind to accumulate this instrument at that lower price as well. But at the same time, if it doesn't hit that strike price, they're still pocketing the premium.
Yeah, absolutely.
Which is really good. Yeah, so these are the strategies that people can consider in a downtrending or sideways market. Yes.
Yeah, and we already discussed about diversification. I think it's obviously very important to continue to emphasize the importance of a diversification in any kind of a market scenario, but especially given that most people would have a long equity and more of a US exposure. I think at this point it's even more important to consider those diversification strategies. Some of the other ways could also be to have some safe havens in your portfolio if you're scared about a downturn. Safe havens like gold, certainly that's the most popular, but also some safe haven currencies like Japanese yen or the Swiss franc. And particularly for people who have exposure to foreign equities, in a sense, they also have foreign exchange exposure, right? So I think people could also consider hedging that FX exposure. So I think that's really important for people with foreign portfolios. And if someone's really bold, then they can also certainly try out an inverse ETF.
So those are very interesting suggestions that you mentioned. And in fact, for investors who like to be exposed to these instruments, Saxo does provide them on the platform, from FX to futures as well as options as well.
Yeah, absolutely.
Yes. So for those who are beginners to options, we do have materials and articles that will explain to you how options works and what kind of option strategies are suitable for the different market environments. Yes. So if you liked this video, please give us a like and subscribe, and we look forward to seeing you in the next one. Thank you.